Don't worry about how you're looking. I know you would look better in person. I'll already calculate that in my mind. So you can please feel free to switch on the camera. I am also see the topic of mutual fund, and which is what we're here to talk about today. It's such a, I mean, for some people who know it, it is so easy, and then sometimes it can appear to be too simplistic. And for some people who don't know it, it can actually appear to be even basic things like, oh, what is equity or what is debt? It's all going over my head. What is she talking? She's going too fast. So, I do understand that it's a very varied sort of audience, which is what we're being told. So I'm going to make an attempt to try and cover as much as I can. So there could be patches where you could feel it's too simple, or maybe patches where you could say it's too complicated. Of course, if it's too complicated, please ask questions. Even if I'm not pausing for questions, you can continuously type your questions in chat or unmute yourself and ask me straight. That's totally fine. Gayatri is here from Sol team, and she's gonna try help answering those questions or point me if there is something specific that I could address right then. So, I think that's how I would like to do this. Have we circulated money personality links? Have people taken it?
Yeah, I've dropped it in the chat. So if we can get a quick thumbs up for everyone who's taken the test, that would be helpful.
There is a link in the chat that Gayatri has dropped. It's a money personality test that we built. And if you could start with taking that, it takes you 3 minutes to take that test. It would really help you absorb better from the session. So thanks for doing it, Aarti. And if some of you have done it, you can actually start putting on the chat, what cohort are you? What were you? Were you an anxious artichoke, or were you a okay olive? You could start putting that in the chat groups. Yeah, and it's posted here, and I think I can maybe just post it again in the.
I can repost it, the link.
Yeah, I've reposted it so that it's right on the top. I'm giving you exactly 2 more minutes to complete the test before we start talking. Cautious cabbage. Aarti is a cautious cabbage. Great, Aarti. We'll talk about what it means as we go along. Don't worry about it. But I do hope that while you were answering some of those questions, you got to think about. Sunita ji, there is a link here. I can repost it. If you can just take that test, just click on this link. Gayatri's posted it back. Take that test. Those are 15, 16 questions, but those are the things that I want you to think about. Do you participate in conversations around money? What comes to your mind when certain words come? So, some of those very thought-provoking questions. And let me share with you that while we build this test, 2 lakh 20,000 people in India have actually taken this test. So when we give you your cohort, that's come with backed with a lot of data and science behind it. And I'm going to talk a little more about it as we progress. Okay, let's start. You can complete the test if you're still at it. But let me tell you about why. What are we doing, and what do these things mean? So we truly believe that money and our relationship with this is actually a series of cumulative life experiences. Basically, what I mean by that is we've grown up listening about money or not listening about it in some form or the other. Like, right, for example, some of us would see that your mother would probably be in charge of the entire household, and the father would give all the money in her hands and then she would run it, or the other way, and then he eventually takes some from her and does his own pocket expenses, or the other way around where she would take pocket expenses from him and maybe took something out of his wallet without even him knowing when she had to sponsor that extra movie for you. So some of us have actually seen money or not seen it in some form or the other as we grow. And today, your relationship, what you have with money, whether you're anxious with it, whether you are overtly cautious with it sometimes, and hence maybe not enjoying life as you can, and maybe you're okay with your money life overall, or maybe you're okay with it, or you're very sorted, very methodical, you go strictly by numbers, or maybe you're discerning. You Discerning donor basically means that you're acting a lot on intuition. Any discerning donuts here? Anyone who got discerning donuts at all? Uh, but basically, we feel money is a lot to do with psychology and less to do with mathematics. So when you are actually managing your money, or when you want to take charge, it's less about maths and more about what you're uh, what you believe and how is your behavior towards it. Why is it even important to talk about money? So we inflation is really the starting point. So inflation is not only about कि टमाटर का प्याज क्या है या प्याज का भाव क्या है, right? It is literally affecting the value of your money. There's a very particular reason I've taken these particular years, but imagine if someone actually put out 1 lakh rupees in a bunny, in a cupboard, under a mattress, doesn't matter. But if someone did that in 1984, by the time demonetization happened, that value of that 1 lakh was actually 7,451 rupees. So, it really did happen with me. Like my mom, I remember calling me saying, "What happened to my money? Where did it go?" And, that's really the starting point for us to understand that if we don't deal with it, if we just keep it in the locker or in the cupboard, then that's not helping us anywhere, right? So if inflation, I have taken an estimate of 5.5, actually today it's about 6.5. And inflation is at about 5.5, 6, 6.5. If your bank is giving you an interest of 3%, all banks today, SBI is giving 2.5. Most of the banks are giving 3%. IndusInd gives a higher interest slab, but that to above 10 lakhs. Until then, you're earning 3% on it, right? So if you are doing that, then this is what is happening to your money. Your money is losing its value, right? It's not probably losing at the rate of 6.5%, which is inflation, but it's still going to lose at the rate of 2.5, 3, or 3.5%. So what do we do? How do we get out of this? Of course, and I don't necessarily am trying to promote stock market instruments, but I'm just trying to show you the difference that on the other hand, If we invested in anything that got us 12% or even 10%, at least we would be making some money on our money. Our money value would have gained rather than deteriorated, right? Is everybody with me? Am I going fast, slow? I can see responses coming in for the money personality test still. That's great. Um, sorry, am I just want to stop and at this point check if it's okay if you can show me any reaction, thumbs up, anything in the window to tell me I'm going at a reasonable pace. Great. Let's go back. So yeah, let's talk about, sorry. What are the things? The problem with most women and investing is that we are usually at this bottom spectrum. We put money in fixed deposits or we do savings account, and that's where the money keeps lying. If it is a normalized money that's gone through the banking system, this is where that money is lying. Or some of us have got very inspired in COVID and have gone ekdam end of the spectrum towards stocks, you know. But I just want to remind that there is a whole lot of things in between where you might not take that much risk. The way this axis is going up, risk is increasing and so is return, right? So fixed deposit and savings account being at the lowest end, then of course there's gold, then debt mutual funds, hybrid mutual funds, equity index funds. If you don't understand what a debt mutual fund or a hybrid fund is, don't worry about it. We'll talk about it later. But I just want you to keep this in mind that as the returns go up, the risk also goes up. And, you know, uh, rather than being at both end of the spectrums, sustainable wealth for future can be created by being in the middle of the spectrum. And that's the message that I want to leave you all with. So, usually in my career, and I've had a long stint where I've handled money for other people. I've been a wealth advisor, I've been uh, a banker, and for all segments, affluent, HNI, ultra HNI. And, most of the money regrets are either you waited too long, you did not understand your risk appetite and put all your money in FDs, buying a whole life policy. So the moment you are combining insurance and investment, it's not a great combination. You're unnecessarily subjecting yourself to lock-ins, compulsory payouts, penalties, even if I put the charges aside, right? So these whole life policies and insurance policies that are sold as investment, there are much simpler ways to achieve the same objectives. Of course, identifying your goals, like, whether you need money for the children, whether you need to buy a house, maybe you want to sponsor a business for yourself, a startup, maybe you want to go for some courses later in life. Any of those, not identifying your goal and not building towards it. And then, of course, credit card rollovers. I think that is one thing I probably don't need to remind this crowd, that credit card rollovers don't help anybody for that matter. So, I'm sure that's something that this crowd probably doesn't need reminders on. But yeah, we just want to put it out there. And of course, keep waiting in the market to enter at the right levels. If you're trying to time the market, it might not really even end up giving you the right kind of returns. So let's discuss some of these. And of course, one thing I want to really outline is that like I said earlier also, that your psychology or your behavior towards money and your investment and the instruments that you're investing in actually make a lot of difference between the outcome. So I've had many instances where people would start with saying, no, I'm an investor and I'm a long-term investor. And the moment either market goes extremely high or it goes, into a volatile phase where it's up and down too much, then they start feeling like निकल जाए क्या करें, बहुत अभी तो नीचे हो गया है या बहुत ऊपर हो गया है. So ideally, that is a difference between a speculator and an investor. Investor say understands कि ठीक है थोड़ा ऊपर नीचे होगा, let's continue. Or even if it's 300% return, first of all, an investor would never really invest in some single instrument that will give it 300% return, right? And the moment someone's doing that, you got to think, okay, am I even in the right place if they're talking about those kind of returns? Because I don't have the kind of time to research these things. Or the market goes down and suddenly you start feeling very anxious about it, then that's also not needed for long-term investor. So let's understand how not to worry about these. Before I get into that, I just want to again put this point across with some examples here. So let's talk about two women, Reena and Devi. Reena has started investing in 2002. She's invested about 10,000 rupees monthly in an index fund. Don't worry about what an index fund is. I will explain it later. But just think of it as investing in stock market. Okay. She's invested in a mutual fund associated with Indian stock market, equity stock market. And when she started doing that in 2002, she has seen 8 bear recessions. She's seen recession. She's seen 2 big market crashes on a single day. Market fell by 25%. She's seen global pandemic. She's seen everything. But usne 20 saal mein, she's invested 24 lakhs. And that 24 lakhs has become 2.05 crores. Devi, on the other hand, started investing in 2020. She's invested only about 3.6 lakhs, but she's seen a great run. She's seen Sensex from 26,000 to what yesterday, I mean, even above 64,000. Post-pandemic euphoria, everything's opening up. India is shining. I mean, we're doing great as a democracy. Corporate results are great. But even after such a brilliant run, from that 3.6 lakhs, it's just become 5.16 lakhs. What is the difference between these two ladies? It's just the time that they are invested for. It's not about the timing or when did Devi get in and when did Reena get in. The only difference is that Reena has an 18-year lead on Devi to have invested in the markets. So I hope that everyone's appreciating what I'm trying to say here. So timing the market is not important. The time you stay in it, that is more important. So, mutual funds are a great instrument for playing that long game, right? Because I'm a time poor customer. I don't know about you all, but I really am a time poor customer. I have a house to manage. I have a 13-year-old to take care of. I have work that I do, startup that we are trying to build up. So, obviously I don't have time to actually, study every stock that I'm investing in. So, I don't want to day trade. I don't want to speculate. I don't want to buy into stocks just because they're in fashion. Or, I feel ki fear of missing out, FOMO ho jata hai, that, oh, usne is stock mein invest kiya, maine to dale hi nahi hai. I don't have the time to do technical analysis. I don't want to pay high fees, and I would definitely, like I said earlier also, invest in insurance. Insurance is an instrument for protection. It's like how you buy, and I think Gayatri, just correct me if I'm wrong, we are doing a whole session on insurance, right?
Yes, next weekend is a session on insurance.
So we're going to talk more about that, but I just leave you with this brief thing that let's not combine investment and insurance. It's a completely different topic altogether, and we cover it next week. But if I am a investor and not a speculator who wants to build sustainable wealth, I will buy index funds. I would like to diversify and not put all my eggs in one basket. I will want to pay the least fees, and I would like to stick with my goals, right? So these are the some of the good things that long-term investors do. Let's just get the elephant out of the room in terms of what are mutual funds. Itna suna hai naam, and everybody just assumes ki pata hi hai mutual funds kya hai. But I'm still so sorry for people who think this is too simple, but I just want to not leave any room for ambiguity here. But what are mutual funds? So let's say today, in this room, you are about 27, 28 of you. If I asked all of you to pool money, all 28 of you, to put 100 rupees each in a pot, and that I used that 2800 rupees to buy either stocks, which is listed stocks on the stock exchange, or bonds like government bonds, or HDFC Bank bonds, or Shriram Transport bonds. And I will talk a little bit about more what is debt and what is equity. So don't worry if you're not getting that difference right now, but just think of it as investing it in the market to get different kinds of returns, to generate returns from there and give it back to you. So if you all gave me 100 rupees, and that 2800 rupees, I made it into 3000 rupees, then that 3000 rupees gets divided back in equally again into the 28 of us, and we've made profit on it. That is what a mutual fund does, right? What are the advantages? One, it is affordable. So for example, if today somebody wanted to put 1000 rupees, okay, and I know I'm taking small numbers, but if somebody wanted to put 1000 rupees in the market, right? Now with 1000 rupees, let's say I wanted to buy Kotak Bank. तो कोटक बैंक तो आएगा ही नहीं, बिकॉज कोटक बैंक का तो स्टॉक प्राइस इज 1803, राइट? सो कोटक बैंक तो आई कांट अफोर्ड ओनली विद दैट 1000 rupees. What will come with that 1000 rupees? Okay, maybe I'll be like, able to buy one central banker stock, in Yes Bank stock, SBI I'll be able to buy, UCO Bank I'll buy in 40 rupees. But I won't be able to buy, if I had 1000 rupees, I won't be able to buy these marquee names like Kotak or Infosys, and so I'm not participating in that, right? Secondly, so I mean, Infosys stock today is at about 1500 rupees. I won't be able to buy it with my 1000 rupees. But in a mutual fund, if we all pooled in the money, then with that 1000 rupees, the fund manager will buy 50 stocks, right? Because at a larger level, it is 2800 rupees and not your 100 rupees. So with that 50 stocks, one, I get diversification. I get participation across all these sectors, across all these, different kind of companies, different, size and scale of companies. I get participation. So it's diversified. It's professionally managed. So as a fund manager, I will very clearly take a call on whether I should invest in Infosys or TCS or Mindtree. That today, even if I took you to vote right now, right? Trust me, all of you will not only give me different answers, but all of you will have a very different reason why you're telling. Some of you tell me Infosys, you'll probably say, because वो उसका दामाद अभी यूके का प्राइम मिनिस्टर बन गया है तो शायद कंपनी को कुछ फायदा होगा, और you'll say no TCS, because TCS is a professionally managed company and there is no question of founder interest conflict. So all of you will have opinions mostly based on hearsay and emotional, or maybe even things that we've read about certain people. It's not necessarily, we're not necessarily researching, right? So it's professionally managed. And of course, they are well regulated. So people are not looking to sort of swindle or put it in instruments which are not regulated on the market. So one thing that I want to talk about here is in a mutual fund, because it is professionally managed, someone is taking a fees from us to manage these funds. And that is what is called expense ratio. Just park this thought for me right now. We'll discuss a little more about expense ratio as we go along, but I just want you to park this thought right now. Gayatri, I don't know if there's something coming on the chat. I'm not looking at the chat. So if there's anything, just let me know.
So far, so good.
Okay, great. Let's look at equity and debt. What is equity and debt? And honestly, आप लोगों को, I'll simplify it really. If I have to oversimplify, then debt is actually, think of it like a fixed deposit. Your fixed deposit that you do in your bank is nothing but a debt instrument. So debt is actually something where you give money to someone is borrowing money from you, which they will repay at a predefined interest rate, usually predefined period, that 12 mahine mein we'll give this money back to you, or 15 months mein we'll give this money back to you, or 18 months mein we'll give this money back to you, right? And this is going to be the interest for this. So it's money that someone's borrowing, giving you fixed interest mostly, or some interest which is predetermined, and the period of the time that you're lending it to them is also fixed. Equity is when you're taking ownership in a company. Now, when you're taking ownership in a company, what is it that gives you the returns? It's actually the appreciation in the stock value plus profits. So, first of all, appreciation in stock value will happen if the company will make profits, right? And also, sometimes those profits can be distributed in form of dividends. So इक्विटी में आपको अप्रिसिएशन ऑफ स्टॉक वैल्यू, आपने 100 रुपए में खरीदा था, वो 100 आज 250 हो गया. सो दैट 150 रुपए यू हैव मेड, राइट? बट इन डेट, अगर आपने 100 रुपए किसी को दिया है तो आपको उस पे 7% का इंटरेस्ट मिल रहा है, तो आपको 7 रुपए इंटरेस्ट के मिल रहे हैं. सो ऑफ कोर्स योर earning is more, it can be more in equity and will typically be not so high in debt, but that is because your risk is lower in debt versus equity. I am not using the word zero. There is nothing like zero risk. Even bank account, when you put a FD in your bank account, RBI guarantees your money only up to 10 lakhs, right? So there is no guarantee. Please do not think debt is guaranteed return. Debt is lower risk. Equity is higher risk. It's not zero risk, right? Let's talk about, and that is why equity also becomes something that you do for long term and debt for short term. इसको आप अभी पाक करके रखिए, short term, long term. मैं इसको with examples I will explain to you so that this concept of why long term is needed becomes slightly clearer, and what is long term. Some of these, as I will go along, I will answer, but just keep this packed in your head that debt is short term, equity is long term. Just go with me for this concept for now, right? So that is why it is very important for you to know, ideally, before you're investing or you think of investing your money, one very important question to know is, by when do you need this money back? Do you need it in a year, let's say for a 25th anniversary celebration in Maldives? Or do you need it in like 2 to 3 years because you need to change your car, or you have your kids wedding coming in, or some education that you need to sponsor, or you have 5 years plus, all my immediate goals are met. Yes, I have some 1 year need, uska maine alag parking kiya hai, but this money that I'm now talking about is 5 years plus, because this is what I'm going to use later. So this bucketing of money is very, very important concept, and I need you to understand that. What we have built at Salt, we've actually built a artificial intelligence tool that where you can put in how much, let's say, are you willing to invest. If you're with me, look at the left of the screen where my cursor is. where I'm saying 30,000 jahan pe likha hua hai, you can put in 10,000, 5,000, 500,000, doesn't matter, 3 lakhs, whatever amount you'll put, it'll take. What is the time period that you got to stay invested in? So, typically you can say 1 to 3 years or 3 to 5 years. And what is the risk capacity? The problem is a lot of us think either we think we want everything high returns and low risk, or we think, okay, we are good to go with high returns, but I don't want to take too much risk on it. And even if I'm taking risk, mujhe jaldi nikalna hai. So that combination just doesn't work. And the reason I'm talking about this AI tool at this stage is because I need you to understand these 3 levers: the amount that you're putting in, the period that you're putting it in for, and the risk that you're willing to take. And if you actually play on this tool on the Salt app, you'll, and you choose moderate risk, and then you choose 3 to 5 years, you will see funds that are coming up that will say, oh, year on year it has given 26% return. The moment you say, okay, low risk, with 1 to 3 years, you will see funds that are giving 19% return. So aap apne aap dekhoge ki, how the return percentage is changing from 30 to 19, or maybe even 12, or 45, depending on these 3 parameters, are largely the time and the risk that you're choosing. So it's a great tool to sort of understand your own risk appetite. I just want to quickly cover large, small, mid cap, because these are usually the questions that we hear. If you feel that this is very basic, I will skip it. So I'm going to talk about it very quickly. Large cap is nothing but, because these are over abused words. You hear them all the time. Basically, large, small, and mid caps, unlike the picture in the PPT, actually refers to market capitalizations of listed stock. So all the stock that is listed on the stock exchange, whether that is BSE or NSE in India, they have market capitalization. Market capitalization is nothing but the full money that they have raised in public. Okay. And that the first 100 companies, based on market capitalization ranking, literally 1 to 100, that is called large cap. These will usually be very known names like Reliance, Infosys, Kotak, SBI, very, very known names. No surprises here. You will know and possibly be able to name each and every company of BSE 50 and Nifty 50. And that is what large cap is, the top 100 companies. Mid cap is literally the 101st to the 250th company, right? These could be companies like Apollo Tires, Gillette India, some of these steel companies are there. So again, some names you would have heard, some you've not heard so much, but moderate kind of risk. And small cap is literally the ones, everything after 250th company. Usually these are companies that most of them you might not even have heard the names of, right? And obviously now when you think about it, these larger companies, when you invest in Infosys, Reliance, SBI, there is less risk that you are taking, right? So if you look at from a risk perspective, large cap is low risk. As you move towards small cap, it is high risk. I just wanted to get these concepts out of my way so that when I talk about portfolios and construction, then you have a lot more clarity. I uttered the word index fund a lot of times. Index funds are nothing but जहाँ पे fund manager अपना कोई दिमाग नहीं लगा रहा, he has no theme, nothing. They are basically mirroring. So exactly जो अभी मैंने बोला, top 100 companies of India. So if there is a Nifty 50 which will have the top 50 companies, then the fund manager simply mimicking the index. So basically simply mirroring the same combination, exact same. He's not doing any selection there, no elimination, nothing. Index fund is simply whatever is there in the firm. So usually these index funds will have a name like Nifty 50, Axis, Axis Nifty 100, UTI Nifty 200, DSP Nifty 50. So these are index funds where there is no one's doing any choosing for you. Literally, whatever is how the index is composed. जो आप न्यूज में सुनते हो आज इंडेक्स 66,000 का लेवल क्रॉस कर गया, that is index, that is the top 50 companies. So index funds are simply investing in them. ELSS are nothing but equity linked savings schemes. For a lot of us who are not salaried or are not in the senior citizens age group, we still need to manage our tax saving instruments. So the ATC benefit that you get under 1,50,000 ELSS equity linked savings schemes are those kind of mutual funds that help you do that. Contra is nothing but where they are taking a bet in the up, like slightly different, like thoda hatke types view agar wo log le rahe market mein, that is what is contra. So for example, if the flavor today is banking and one fund manager thinks, oh, because everybody is running behind banking stocks, then pharmaceutical stocks are available very cheap. And I genuinely feel that in 3 years, it's going to do very well. So he's taking a contra view in that case. And that is what is contra, right? Again, thematic is when like a infrastructure fund or banking and financial services where they're, like as the name suggests, they're investing in particularly those kind of companies. A value fund is where they think, I'm not thinking कि मुझे large cap, mid cap, small cap लेना है, कि मुझे कोई particular thematic में लेना है या मुझे ऐसा कुछ भी नहीं है. Wherever I will find that the stock price is underpriced and this is going to go, this is going to go too well. It's not discovered as yet, or maybe the market is discounting it too much for whatever reason. There is value discovery nahi hui hai. Those are the stocks that I will buy. And fund of funds are nothing where mutual funds are actually investing in other funds. These, like a lot of these international funds like Motilal Oswal S&P 500 is investing in the US market. Or for example, there is, so there they are not going directly investing in the US market. They are basically investing in another mutual fund that is investing in the US market. So those are what are called, FOF funds. Do you want me to pause here? Look at any questions, any clarification? Am I going too slow? Is it boring everybody? I hope people are not sleeping on the Saturday afternoon. Yeah, so these are what are, let's get into debt mutual fund types, right? And most people think that when they hear the word mutual fund, they only think that there's equity mutual fund. No, there is debt mutual funds also. That's why when you go to a good advisor, or if you know one, if you can do it yourself, then there are many ways, and debt mutual funds, various different types, where liquid funds are something where you could put money, liquid or ultra short duration funds. Large companies, large treasuries even put monies in liquid and ultra short duration funds for a weekend. Like, so if it's 1,000 crores or 5,000 crores or 10,000 crores, then you put it even on the weekend, and if you get a few 10 paisa on that, then that's quite a lot, right, on that volume of money. Or if you know that you're going to need it in 2 months, your bank account will probably give you 3%, but a liquid fund might end up on an annualized basis end up giving you 6-7%. Bank account is also giving you 3% annualized. It is not giving you 3% for 2 months. So just when you're thinking about it like that, that's how you compare it. You look at the annual return क्या मिलेगा, and of course आपको जो actual return मिलेगा वो उतना ही मिलेगा जितने दिन आपने पैसा रखा है. You will not get it for the whole year. And
there are a few questions in the chat box for you.
Yeah. Yes, Lata, tax benefit have been removed from debt mutual funds. So they are no longer attractive from a taxation perspective. But like I said, if you are sometimes for larger volumes of money, let's say you got money from a real estate sale and it is a slightly larger amount, let's say 10 crores, and you need it in 3 months or 4 months back. It's not like you can invest it for long term. But then for that kind of money, even if you were to put it in liquid funds or ultra short duration funds, you will still end up making more than what you would make in the bank account, right? Or arbitrage funds, for example. What are arbitrage funds? Arbitrage funds are basically a fund. So arbitrage funds are a great idea if you want to park for anywhere between 6 months to 1 year. So you don't want to take risk on equity. Arbitrage funds are nothing but taking no particular bet in the market. A fund manager doesn't take any bet in the market. He invests. Let's say if he went and invested money in Infosys, he will go. So he's bought Infosys. He will also go sell Infosys at some fixed percentage of profit with 3 months time frame, and he will also have already done that trade. So in an arbitrage fund, you are taking a equal and opposite, sort of holding in both directions. So you're not taking a bet on the market. And an arbitrage fund today can give anywhere between 4.5% to 5%. But the advantage of an arbitrage fund is that it is equity taxation. So you'll still end up paying 15% on it rather than paying 3%, pay 30% if you are in the higher tax bracket in your bank account. So we should not dismiss it completely that usko koi benefit nahi hai. It really depends on what your situation is. How long are you willing to invest for? But yeah, debt funds basically can offer you solutions right from 10 days to 3 years to 7 years. Kind of, you want to create a not so risky part in your portfolio. So yes, Lata, some private banks are giving 6 to 7%. I did cover that. I don't know if you were there in the beginning of my presentation. I did say that some banks are giving 6 to 7% on savings account, largely 2 or 3 banks that I can name on my fingertips, but I don't want to get into that. And most of them give it above a particular threshold. So IndusInd, for example, gives it above 10 lakhs. So like I said, when I'm talking 3%, I am talking about retail kind of money. And yeah, if you're holding 10 lakhs plus, then you might get 6% on your money. And then, of course, it makes no sense for you to, put money in an ultra short fund. How do money market funds versus liquid funds? So, liquid funds are basically literally based on overnight. They are sort of designed to meet overnight kind of liquidity for larger corporates, right? So most of them have LIBOR, which is London index related rates, or MIBOR related rates. These are all indexes of debt, internationally acceptable indexes of debt. So they link the rate to that, and that's how I'm actually trying to put it in the simplest form so that people don't get confused, but liquid funds are largely for overnight solutions. Money market, on the other hand, will have some exposure to corporate deposits or some instrument that will have a longer maturity cycle. So, anywhere between ranging from 3 months to 1 year or even up to 2 years. So that's why money market funds and liquid funds में थोड़ा सा फर्क होता है in terms of your horizon that you're willing to invest in, and hence the little bit extra risk that you end up taking. So I hope I answered you, Bhavna. Yeah, so the one thing before getting into portfolio construction, one more concept that most people get wrong is this, and it's a true story that I want to share at this point of time. There was this famous Swedish statistician. He wanted to actually cross a river. The man was 6 foot tall. He asked everybody around, what is the average depth of this river? He asked about 8 or 9 people along the banks of the river. Everybody said 3 feet. And he said, okay, I'm a 6 foot man. I can easily cross a 3 foot river. It's water's going to come up to my waist at max. Now, the man starts walking, crossing the river, and there comes a point somewhere in the middle of the river where there's a gorge, which is 8 foot long, right? So obviously, this man goes head down into that gorge. And now, what does that really mean? Why am I telling you this story in the middle of equity and debt? Because this is how average return on equity varies, right? So equities actually vary from, there are, so when we think of returns, we think, oh, equity has given 12% return average in the last 20 years. That means if I put 1,000 rupees, I'll keep earning 12%, 12%, 12%, 12% for 5 years. No, that's not how it works. The markets will go up and down. They will be volatile, especially in equity, because they are based on a lot of factors. They're based on, like I said, equity is based on the share price, right, of the company. What are the profits it's generating? What is the macroeconomic environment? If for some reason, if it's a defense stock and there's something wrong, some let's say bad quality defense happens that the company is banned to supply, then suddenly that, the forget about the profit that it's making, its order book will look very, very diminished. So maybe they will bounce back, but for then it will look very diminished. Or maybe it's a macroeconomic factor, like, suddenly election is around the corner and market is expecting one party to win, but the other one wins, or there is khichdi government happening, any of those things, scenarios happening, right? So in equity, what happens is the returns will vary every year. And this is why in that slide I said, for equity, you need to be long run. In my career in the last 20 years, I have never seen a 3-year cycle of equity that is negative in India. So if you're investing with a 3 to 5 year outlook, equity will end up giving you better returns than most asset classes. And as of today, I can say that even including tax. So when you think of equity, that's why you need to think long term. Long term, 3 years plus is a good long term to follow. And 12% or 13% average will come, but it might not come like every year, cut. It will, some year it will be up, some year it will be down. So that's something that we need to keep in mind. Let's also clear one more concept. A lot of people think SIP is a product. Many SIP may invest here. SIP is nothing but a mechanism, right? Where you are investing in a mutual fund, whether it's debt or equity, you are investing in a mutual fund, but on a systematic manner. Every month, the amount is auto-debited on a fixed date from your bank account, fixed amount every month. Lump sum is when you invest basically as and when you like, and as and when you have liquidity, and it's mostly a one-time thing, right? In a SIP, you can actually start as low as 500 rupees also. Usually, most funds in lump sum will have some minimum, requirement. Most of the good ones have like 5,000 rupees that you need to invest at least, and some start at 100 also. So that's one difference. For a SIP, you obviously can stop it, you can pause it, you can tweak it, and there is no penalty for doing any of this. And that's why this is a much better mechanism than investing in those insurance policies that are linked with investments. So obviously SIP is great for creating that discipline. It also automates your investing. You don't have to worry about, I didn't invest this month. And, for people who don't have necessarily a fixed source of money coming in, and, let's say you get your Diwali ke lifafe or Rakhi ke lifafa or birthday money, and, you want to invest in lump sum, there's absolutely no harm. There's no difference in returns It's just the mechanism of investing in. So SIPs are great if you're a salaried person and you know your fixed sum. But if you're a freelancer, or maybe your income flows are irregular, like even maybe a homemaker, then you might not want to do a SIP, and that might actually create more stress. So then you can just go lump sum, and it's totally fine as well. So yeah, let's. I think I'm gonna go into this. This is an important concept, that what is direct and what is regular. Remember when I was talking about mutual funds, I explained something called an expense ratio, which is basically nothing but the fee that a fund manager is taking for managing their funds, managing our funds, professionally managing our funds. There is another component in that expense ratio, which is nothing but the fees or commission to the middleman. So a direct plan is basically where you're investing straight into the asset management company, straight into the mutual fund. A regular plan is when you are actually investing through a middle person. This middle person could be your banker, it could be your investment advisor, it could be your financial advisor, like somebody, some Jain Investments, or I mean any of those. There's lots out there. Most 70 to 80% of the market in India actually works on regular plan, because they basically you have that middleman who takes the commission here. They don't take it from you, but they take it out of your returns, right? So if the fund name, so for example, if it is ICICI Blue Chip Fund, if it is direct, it will say specifically direct. If it doesn't say anything, if it just says ICICI Blue Chip Fund, that means by default it is regular. Regular was always existing. SEBI asked mutual fund people to come out with the direct option in 2009, because they realized that a lot of mutual funds were charging very, very high commissions and paying it out to the distributors, and retail investors were not even aware of it. So that's why the concept of direct got introduced by SEBI in 2009. Let's look at what does it really mean for you, right? So for example, if you have invested 10 lakh of rupees 10 years back, when SEBI came out with this directive, you said, great, I'm investing 10 lakhs. Just by virtue of 12% return in the last 10 years, which is what market has given, और कहीं नहीं आपने index fund में ही लगाया होता तो आपको इतना return मिल गया होता. That 10 lakhs today would have actually become 24.5 lakhs approximately in a regular fund, जो आपने अपने banker के साथ लगाया. Great, superb return you've got. But अगर वो आपने direct में लगाया होता, so you would have got at least almost 2.5 lakhs extra. That return is being eaten out of your own return. That commission is being eaten out of your own return, and you don't realize it because it doesn't get published in the NAV. And look at its, how it impacts you over a 20-year period. If you've invested this 10 lakh rupees, you've actually paid more commission to the person than what you've even invested, right? So this is how it works. The way I explained averages, and these are the averages in the market. So of course, there is equity, and in this equity, the green line is equity. I think all of you now understand what equity looks like. And equity, regardless of आपने mutual fund किया या कुछ भी किया, आप अगर इसमें एक average line बनाएंगे, so in the last 20 years, that average would fall at about 15%. The red line here is gold, and gold on an average in the last 20 years has given about 9% return. And this blue line here is debt, which is nothing but, fixed debt. So this is how it is. Of course, one should look at Hemlata ji, I will just answer your question in a while. I'll show you how we are trying to solve that problem. And there are a lot of people like us in the market who are actually solving for this problem, but I'll come to that. But let's also learn about, what is very important in when you're investing, whether you invest through mutual funds or whether you invest through any of your in any form in the market, is if you, let's say, you got in and you said, okay, I will make 12% return, and for some reason you made your 38% return or 48% return, it might not be a bad idea to actually capture that return. Just take out the return from the market. Either if you need the money quicker than, less than 1 year, you park that in an FT, best investment, and that's a great idea. And if you don't want to, sort of park it in an FD, even if you reinvest it back into the market, at least, you have taken some returns and gotten off from the market. So one should look at, when you're investing in mutual funds, one has to look at, of course, what are you investing into? First of all, appropriate to your risk appetite. Don't put all your money in fixed deposits and be contented with it. And then even if you're putting your money in mutual fund, every 6 months, at least make sure that you review it. Okay, what is it that it's going? You don't need to sit on it every day. Like I said, we are time poor customers. And if you are a time poor customer, you don't need to sit and research on the stocks. Like, trust me, I know of enough people who started a direct equity portfolio in COVID. And despite the market giving phenomenal returns till then, from then, some of them are still sitting on their direct equity portfolios that have either are a negative or they don't know what to do with it, right? Because if you don't have the time to research or sit on it or trade every day, and also one more statistic I would like to give you, only 2% of traders in India actually make money. So, one needs to, if you're giving money to a mutual fund manager to professionally manage it, then one has to look at if you're looking at sustainable wealth creation, then it has to be a sustained effort. It can't be aaj man kiya to kar liya aur kal nahi kiya to nahi kiya, right? Someone has to be at it far more regularly, and that's why it might be better off to give it to a professional. One more quick concept. I think I've already covered it in some form or the other, but I think when I talk about it like this, the numbers are always very striking to most people. Let's look at two examples. There's Anjali, who started investing at the age of 30, and she invested 10,000 rupees per month, and she's she's investing for her future self at 60. And Rahul, on the other hand, is 40 years old, and he's also investing 10,000 rupees per month, again for the age of 60. Uh, Anjali is in this period invested for about 30 years and Rahul for about 20 years. So Anjali is invested about 36 lakhs rupees and Rahul is invested about 24 lakhs rupees. But look at the difference. Invested amount mein bahut zyada difference nahi hai. But see, just by starting 10 years earlier, Anjali's actually made 2.5 crores more than Rahul. Rahul's 24 lakhs has become 1 crore and Anjali's 36 lakhs has become 3.5 crores. And trust me, I can do this example at 40, 50, 50, 60, 55, 65. So I always say, today's the youngest you're ever going to be. So please start investing in yourself. And the next time you're shopping, maybe you want to shop some mutual funds, and build your own 1 crore. And you need to do about 50,000 a month to build it in 10 years. You need to do about 10,000 a month to do it in 21 years. And you need about 3,000 a month to do it in about 30 years. So just some ballpark numbers and food for thought there. What is Salt? Salt is actually a digital platform. It's a super app that we have created where we offer mutual funds in direct. We have a lot of these tools that help you, that I've shown some of the tools that I showed today, like that AI enabled tool. There is a tool to figure out, okay, how much SIP should I start if these are my needs, or oh, I don't know what is my monthly outgo. I'm not able to keep a track. So there's a passbook for that. So what we have done is we built these tools thinking or understanding the psychology of investors and financial behavior patterns, and given you action oriented things, to build your portfolios in. What we have also done, although we are a direct distributor, we have created or curated baskets of funds. So there are 3 funds in a basket that we have curated, where you can start, you can look at a beginner friendly basket, you can look at a retirement basket. Like I said, go and play around on the AI tool. So I think Hemlata ji asked me here that we understand the thing about we understand the thing about direct funds, but we don't have the knowledge. So you can either go pick up these baskets, or you can help with the help of the AI. You can actually pick the right fund that is good for you, and you'll be able to book. I mean, Gayatri is here. She can possibly give you a little more information about our money clubs and how we are helping people do these investments. But we can also help do one-on-one consults for some of you if that's what is needed, and help you to invest in the direct funds. So yeah, I think Rahul should invest more, but clearly the idea is that what I wanted to show is, Hemlata ji, starting, if even if you started 10 years earlier, you didn't have to invest that more. So what is in our time sometimes is to start early, but maybe not necessarily to be able to save more. And of course, if you have the capacity to save more, then like I said, you can build your first crore in 10 years also by just doing 50,000 a month instead of doing 10,000 a month. So yeah, that's why these are the 3 important in the AI. Also, I showed amount, the time you're investing for, and the risk you're willing to take. These are the 3 important pillars that you can play around with. So Bhavna, a lot of these apps are today available, like Salt, where you can actually invest in direct funds. We give you a very nice looking dashboard. You can monitor your funds. We even have money coaches, and we can do one-on-one consults for people. That's the whole reason why we built an organization. And that's what we're trying to do, in fact, in our startup. I mean, if I have time and everybody has time, I can give a quick demo of how we're doing it on Salt, but I don't want to make this about Salt. But yeah, you could get in touch with Gayatri or join the Money Club, and she'll be able to give you more information. I'm opening the floor for questions. So you can unmute yourself, and I would be happy to give an overview of Salt if everyone else is okay with it. I don't know if we have people from women listed here.
Yes, ma'am.
Okay. Just give me a second and open.
Yes, I am here.
Okay, great. So we're okay to give a demo of Salt, right? I'm just.
Yes.
Okay, I'm just give me a second. I'm going to share my screen. Great. So this is what the app looks like. So like I said, you can go book your one-on-one with a money coach, or you can go yourself, sort of plan your portfolio. There are a lot of these curated portfolios. This is what your dashboard will look like. So I think Bhavna asked, how do I track? So we've tried to simplify it. So for example, I have a model portfolio here, And if someone is invested, let's say 1.7 lakhs, today the value of that 1.7 lakhs is 27. This is a live portfolio, by the way. So it's not a mock portfolio, it's a live portfolio. So the dashboard is pretty simple because this is honestly all I want to know from my funds perspective. Of course, I can go into the dashboard and see, oh, what are the funds that one has invested in? But you can also go into these curated portfolios. So for example, there's turbocharge. There is beginner friendly. Each of these will have 3 funds. And like I explained to you, the concept of equity and debt. So for example, my retirement plan has 2 equity funds. You can see these small tabs here. 2 equity funds and 1 hybrid. Hybrid is nothing but debt and equity combined, right? Then let's say a family fund again has 2 other equity funds and 1 hybrid. What we've also done is, for example, let me click on this. So let's say write out the recession. If I have, so one is, these are defined for you. So, you can quickly read, oh, I forgot what she said about debt. What is debt fund? And then you can quickly read it, first of all. Second, let's say you want to see what are these funds. So let's say there's quant, large and mid cap. Now, if I go into this fund, what does it invest in? What is it really doing? It's given the 30% return in 3 years. I can see that. So risk is also high, but return is also high. I can also see if anyone is interested in that kind of information, they can also see, okay, about this fund, it has 43 stocks, 87% is sitting in equity. What are the stocks? So Reliance Industries, HDFC Bank, DLF, L&T, Jindal Steel, Punjab National Bank, Tata Communications, all names that most of you have heard of, right? And these are the stocks because it's a large cap. You remember I said large cap stocks, most of you will know about them. So it's a combination of a large and mid cap, this particular fund. So actually in the name of the fund itself, you get a lot of information about what the fund is doing. So now the moment either you can go in these portfolios or you say, okay, I don't want to look at these portfolios. She had said index funds are also good. So I'm just going into index and seeing, okay, index ne last 3 saal mein 27% return diya, and that's what these people are also giving. So I'm just going to simply go and put my money in, let's say, DSP Nifty 50 equal weight fund, right? And what we've also done is to make it easier for you. We have given some icons of well-known companies in that portfolio so that you know what what the fund is doing. So that's how you can create SIPs on these. You can there is something called as a test drive or trial returns. I can actually just make believe create a portfolio. I'm not putting actual money in, and then see, okay, I want to just gain some confidence and then I'm going to start investing. So purely mutual funds. Salt is not doing direct equity or stock trading deliberately because we realize that if we are trying to cater to women, then so Bhavna ji, like I said, either you select the curated funds. There are 3 ways to get guided. I think I've repeated myself many times now. I don't know where is the ambiguity. There are 3 ways. One is you can select a one-on-one coaching. Second, you can go through that artificial intelligence tool and see what works for you. Third, आपको वो भी नहीं करना है तो आप ये curated portfolios देख सकते हैं. So these are the 3 ways of getting guided. We are doing direct funds at Salt, so that way there is no commission. So really for us it doesn't matter whether you're coming in with 500 rupees or 5 lakhs rupees or 50 lakhs rupees. The idea is to be able to help you do these investments. You can join the group and Gayatri can give you more details on what are the sessions, how are they charged. You can also, Gayatri, if you can leave your number here, maybe whoever is interested can get in touch with you. There are no charges for the tools as of now and for the curated portfolios, Himlata ji. We're a stockbroker by license. SEBI is actually creating some regulations around execution platforms like us. So we're waiting for those clarifications to come through. But until that happens, there are no charges for executing these transactions through us. So what we have built is basically nothing but an Amazon of all the mutual funds there. You can execute the transaction. We made it very easy कि आपको वहीं का वहीं dashboard दिख जाएगा, clean dashboard with no, which is simple to understand. It's right there. Let's say tomorrow, just for the sake of discussion, just for the sake of, I hope it doesn't happen, but if Sol doesn't survive, your investment is actually happening to the mutual fund. You will get a folio statement of the mutual fund. So you can any which ways reach out to the mutual fund, and most of them are now available online, where you can really just log on to the website and put in the folio number and redeem, buy, whatever. And hopefully Salt continues to exist and we thrive, then you will be able to continue to do your entry, exit, SIPs, everything through Salt. So I hope I answered that ambiguity. Great. Any questions? Anything conceptually that I didn't cover or you were expecting when you came in for a session of mutual funds? I think for the recording, the women listed team will be able to confirm that. Liquid fund versus money market fund versus FDs. So Bhavna ji, it's really depending on, like, honestly, I think Lata ji the beach mein who said that taxation hat gaya abhi debt fund se. So honestly, she's right. I mean, fixed deposits are great. They're convenient. If your idea is to park it for a period, let's say you go into a bank and book your deposit for 12 months. Then and you know कि आपको 12 महीने के पहले पैसा नहीं चाहिएगा, then great, go and put it in the FD. But most people don't understand this about fixed deposits, that if you, let's say, needed money in 6 months, then what you get in 6 months, not only is there a penalty to that breakage, but also, let's say आपने जब FD book किया था या जब आप तोड़ रहे हैं, उस टाइम पे 6 month का रेट is 3% or 3.5% or 4%. Then आपको 6 महीना proportionately 4% annually पे मिलेगा. So I don't know if I've explained it or confused you more, but in a fixed deposit, instead of getting 7% ka aadha, you will actually get 4% pay your money, right? Or 4% ka aadha, because you've only stayed for 6 months. So that's why, fixed deposits are not necessarily a good idea if you don't know your time horizon. If you don't know your time horizon and you know कि 3 months में या 6 महीने में या 9 महीने में पैसा चाहिए, then liquid funds can actually be a great alternative to fixed deposit. But if you know that अच्छा ये आप सिर्फ peace of mind के लिए कर रहे हो, you know that you need it in 12 months or you know you need it in 15 months, then just go book your fixed deposit. Another 2 tips, since somebody's asked, and if I'm not overshooting the time too much, 2 quick tips that I like to give on fixed deposits. When you're booking fixed deposits, you should look at a bank chart and book it for the, let's say आपको कोई फर्क नहीं पड़ता है कि 12 महीने की डिपॉजिट है या 15 महीने की. If you know कि 12 महीने में पैसे चाहिए तो done. Then you don't have an alternative. But it doesn't matter to you whether you get it in 12 months or 15 months or 18 months. And some part of your money will be like that, right? Then rather than looking at your tenure and then looking at the rate, look at the rate chart, look at the highest rate. Sometimes we make the mistake of booking an FD for 3 years. not realizing that the highest rate of the bank was actually in 2 years or 1.5 years. So look at the highest rate on the rate chart and then book your fixed deposit. Also, it might actually be a good idea to break your fixed deposits and book them, so that in case you need the money, you don't end up not only paying the penalty, but also the decreased rate, right, for that time period. So it might be better to actually break your fixed deposits and book them for various tenures. So yeah, I mean, I hope I answered that question on liquid versus fixed deposits. Have I covered everything, Gayatri, on the chat? It's okay. Great. Thank you, everybody. I will hopefully see most of you. I do recognize some names here from last week, and hopefully we'll see you again. Okay, which question did not get answered? I'm just scrolling up to see where is your question. Sorry, Hemlata ji, if you can just unmute yourself and ask me that, that's also okay, because can you find it?
Yes, Nidhi. So
Haan ji,
Nidhi, yeah, Nidhi, the question is, say for example, if I go direct and I don't have knowledge, right? Versus I invested directly with the mutual fund investor, like, the mediator. So since he has a knowledge, he would be able to invest into right portfolios. Then me, I might invest into portfolios which might be, not good or return or having the returns. It happened with me. It really happened with me, where what I did is I gave one of the portion to one investor, another portion to the second investor, and third portion I kept it for myself. And I found that I made a loss when I did a direct.
but
So
did you do direct equity or you did direct mutual funds?
direct mutual funds.
Okay, that is very strange, because I mean, unless you've really gone and selective, पता नहीं आपने कौन से ऐसे mutual fund select किए होंगे जिसमें आपने loss बनाया. I really can't. And what time horizon are we talking of?
I would say
Because if you're talking direct equity, आपने stocks खरीदे सीधे जो डीमैट में आके बैठे, I totally and absolutely understand what you're saying. But in mutual funds, typically the agents or any of the agents are actually advising funds depending on what kind of distribution fees are they getting. So in fact, they are mostly not necessarily selecting the best fund for you, right? And if you can actually use some of these tools, and that's what our team at Salt can help you do, these are very simple. I think अगर आपको आज मेरा session 70 to 80% भी समझ आ गया, you will be able to manage your own money. And I am failing to understand what you would have invested in, which would have a mutual fund that would have given you loss. I will have to look at those instruments for me to be able to comment on it. But in 3 years time frame, even if it was a slightly suboptimal mutual fund that you would have selected, I don't understand what would have given you loss. So we'll have to look at the instrument, Hemlata ji, because 3 years time plus में तो कोई म्यूचुअल फंड का इक्विटी इंस्ट्रूमेंट लॉन्ग टर्म दे ही नहीं सकता. Yeah, so 1 year में, so then are you comparing apples to apples? In the 1 year, are we really comparing apples to apples? Maybe you made a loss in the 1 year, but it was a very aggressive fund, right? And what did you invest in? So that's why I said that knowing your horizon, knowing the amount, and knowing your risk appetite. And that's exactly why we have built that tool using artificial intelligence, that आप उसको देखिए, Salt download करके, you play around with that artificial intelligence tool. You typically, if you set 1 year, it would never even throw you an aggressive fund. It will always take you to a very moderate or low risk fund where you can't sort of possibly incur a loss in 1 year. unless Russia really attacks Ukraine with a nuclear weapon. Okay, Gayatri has put the link for the app download as well. It is an app available on both Play Store and Google Store. Yes,
Tina has question.
Haji, and I see.
Tina, yeah.
Yeah.
Unmute.
Yeah, I wrote the question in the chat box regarding this regular and direct, because I just noticed after listening to you, and it was very useful information, that it would say it in the mutual fund. So I've looked at my mutual fund folios and they're all saying regular, except one is not saying anything. So does that mean that's direct?
No, that's also regular. If it doesn't say anything, it's typically all regular.
Oh,
If
okay.
if it's direct, it will specifically say direct. So I'll tell you why. Because a mutual fund, basically, if you invested 100 rupees and that 100 rupees, like I showed you the graph, became 108, in
Right.
a regular fund, it would have actually become 110. And regular would be showing an NAV of 108, and regular would and direct would be showing an NAV of 110, right? So the NAVs are only different. So they are different, like same exact name, but आगे अगर वो direct है तो वो बहुत specifically उसमें direct लिखा होगा. So for
Okay.
example, if I share my screen again, you know, if you see here, in the Salt app, it, like any fund, let's say I just went to equity funds, let's say any fund, I look at it, Parag Parikh Flexi Cap, it very clearly will say direct. So equity, Flexi Cap, growth, direct, right? It clearly says direct.
Okay, great. Thank you so much. That's very helpful.
Somebody, I did read a question about switching from apps. I don't know what that question was. Can you all unmute yourself and ask the questions? Because now the queue is so large that if we might miss your question. You can just unmute yourself and ask, please.